At Stonebridge, when we analyze a bond, we don't just look at the rating agency analysis or the maturity of the bond. We look at the individual company or municipality. We look at the economics surrounding it, the sector it's in, the state it's located in. We will stress test the bond to make sure that if anything like 2008 financial crisis occurred again, that it can withstand that stress. And we really do our due diligence to make sure that that bond will maintain its credit quality.
What role do bonds play in a portfolio, and is it appropriate for an investor to think they should have an allocation to bonds in their portfolio with the stock market at its all-time highs? We get that question a lot from clients, and it is important for them to realize that if you have a 30% or 40% allocation to bonds today, that what you are doing is protecting the downside of your portfolio. You're protecting the liquidity of the portfolio. But think of it in this way, you still have 60 or 70% of your portfolio allocated to the stock market. We have seen over the last 10 years, clients that came to us when they were 60 years old, they're now 70 years old, they're still 100% invested in equities, and it is inappropriate at this stage of their life to have that much equity exposure. And so we are moving more and more clients into the bond market, short-term maturity structures for liquidity, to lessen volatility in the portfolio, and to make sure that there's an income stream coming in. And as interest rates go up and those bonds mature, it allows for those maturities to be reinvested at potentially higher interest rates to give that client a raise in their income. Very important. It's something that the market is not talking about because of rising interest rates. Rising interest rates is good. It's good for the client, and it's time for clients to start looking at a bond component for their portfolio.